you've watched my previous videos, you'll know that my property journey didn't start with a perfect strategy or a flawless investment plan. Like many people, I started by learning through experience. Over time, I realised something that many investors eventually discover. Buying property is not the difficult part. The difficult part is choosing the right deal. In the last video, we talked about why many property deals fail and how investors often rely on optimistic assumptions rather than realistic analysis. So, today I want to show you the framework I now use when evaluating property opportunities. It's called the CORE framework, and it's the method that I use to assess property deals before committing capital. The reason I created it is simple. Most investors focus almost entirely on projected returns, but good property investing requires looking at deals through a much wider lens. One of the biggest issues I see in property investing is that deals are often analysed too narrowly. An investor will look at the purchase price, the rental income, and the projected yield. If the numbers look attractive, the deal is considered good. But property is far more complex than a simple yield calculation. Operational complexity can change the economics of a deal. Financing risk can change the economics of a deal. Even the exit strategy can completely change the long-term outcome. When investors focus only on projected returns, they're often missing the bigger picture. And that's exactly why many deals that look good on paper become far less attractive in reality. So, instead of asking, what is the yield? I started asking a different set of questions. Questions that eventually became the CORE framework. So, what is the CORE framework? CORE is a structured way of analysing property deals through 4 different lenses. Each lens looks at a different aspect of the investment. The goal is to understand how profitable this property will be and the financial realities behind it. CORE stands for cash flow, operational, risk, and exit. When a deal is assessed across all 4 areas, the strengths and weaknesses become much clearer. Let's go through each part. Cash flow quality. This is the first part of the framework. This is where most investors start, but often where analysis is the weakest. Many deals look profitable because the assumptions behind the numbers are optimistic. Rental income may be based on best case market rents. Maintenance costs may be underestimated. Void periods may not be fully considered. And refinancing costs may be based on current rates rather than stress-tested scenarios. Cash flow quality asks a different question. If the assumptions become slightly less favourable, does the deal still work? If interest rates increase, does the deal still produce acceptable monthly cash flow? If repairs are higher than expected, does the margin still hold? A deal with strong cash flow quality is resilient. A deal with weak cash flow quality often looks good initially, but becomes fragile when conditions change. The second part of the framework is operational control. Some property strategies look extremely profitable on paper, but require significant management. HMOs are a good example of this. They can generate strong rental income, but they also involve multiple tenants, licensing requirements, compliance responsibilities, and ongoing management. Operational control is about understanding how complex the property will be to manage. The more complex the operation, the more systems and oversight are required. For some investors, that might be perfectly manageable. For others, it could be quite overwhelming. A deal might look profitable financially, but still be unsuitable if the complexity of the operations is just too high. The third part of the framework is risk management. This focuses primarily on financing and resilience. Many property deals are heavily dependent on borrowing, which means the investment needs to remain stable even when financing conditions change. If the deal only works under financial conditions, the risk profile may be too high. But if the deal remains stable, even when interest rates rise or refinancing becomes more difficult, the investment is far more resilient. Risk management is about understanding how the deal behaves when conditions aren't perfect. because property is a long-term investment and market conditions inevitably change over time. The final part of the framework is exit clarity. This is one of the most overlooked aspects of property investing. Many investors focus heavily on how to buy a property, but very little spend time thinking about how they will eventually exit that investment. Exit clarity looks at the likely buying pool for that property. So, is the asset broadly appealing to the market, or is it highly specialised? If regulations change, would the property still be attractive to future buyers? If you needed to sell, how liquid would the asset be? Understanding the exit right from the beginning provides far more flexibility later on, because an investment that is difficult to sell can create problems even if the initial numbers look strong. When I evaluate a property opportunity now, I assess the deal across all 4 core areas: cash flow quality, operational control, risk management, and exit clarity. Because sometimes a deal looks attractive financially, but fails when operational complexity is considered. Sometimes the numbers look good, but the financing risk is too high. And sometimes the property itself may be strong, but the exit strategy is weak. By analysing all 4 areas together, the strengths and weaknesses of the investment become much clearer. And that clarity makes decision making that much easier. On this channel, I'll be using the core framework to analyse property deals and explain how they behave beyond the initial spreadsheet. We'll look at real deal examples, investor mistakes, and the operational realities behind the different property strategies. Because ultimately, the strength of your portfolio will depend on the quality of the deals that you choose. And good deals become much easier to recognise when you have a structured way to evaluate them. If this video helped you think about property deals differently, subscribe to the channel, because in future videos I'll be breaking down real property scenarios using the core framework. And if you're currently evaluating property opportunities and want a structured second opinion before committing capital, you can apply for a core deal audit where I analyse potential investments through this framework. Thank you so much for watching, and I'll see you in the next video.